You've been consistent and really paying attention to your finances. You finally saved up your first $10,000. So now, what do? Let's talk about your next moves after saving your first $10,000 to kickstart your wealth building journey. Most people make a critical mistake after saving their first $10,000 and it keeps them stuck financially. So how do we avoid these mistakes and speed up our financial growth? If you're new here, my name is Ron and welcome to Pinoy Stock Investor. In this video, we'll talk about how I use specific ETFs among other assets and the strategies that I use that multiplied my first $10,000. We'll explore assets and investments that can contribute to your long-term growth and potential passive income. So stick around to see these concrete steps and how you can apply them to your financial journey, moving you closer to your financial goals. First off, congratulations! Hitting that first $10,000 is a huge milestone and you should be proud of yourself. It's a proof that your hard work is paying off. Drop a comment below. I'd love to personally congratulate you. But the big question is, what's next? How do we turn this into a real lasting wealth? Let's break it down. Most people let it sit on a savings account earning little to no interest. Others spend it on things that don't create money at all. I was there too. I was able to save my first $10,000 and have no clue what to do next. But I made a few key decisions that changed everything. If you don't take action, inflation will eat away at your money and you'll stay stuck in the paycheck to paycheck cycle. You work so hard to let that happen. Your $10,000 is a tool. It can either work for you or stay stagnant. Let's make it work. With $10,000, there's definitely a lot that we can do. But in order to build the wealth, we need to focus on bringing in more cash flow and owning assets that appreciates in value. One of the assets that multiply my first $10,000 is stocks. A stock represents a small piece of ownership in a company. When you buy a stock, you become a shareholder and you may profit if the company does well. Investing in strong US companies with long-term growth potential can accelerate your wealth building. I bought stocks of Microsoft, Apple, Visa, and Amazon. These are companies that I believe will continue to grow 5 to 10 years from now. These stocks have multiple ways of giving us investors the earnings from our investment. It can be in a form of dividends, buybacks, or just plain reinvesting back its earnings to the company to improve products and services. But buying stocks isn't enough. You need a strategy. I didn't just randomly pick stocks. I focus on companies with consistent revenue growth, which means they keep making more money. Strong competitive advantage that shows that they can dominate their industries. Healthy balance sheets with low debt and high profitability. These are some of the factors that increase the chances that my investment not only grow in value, but survive the market downturns. Make sure to choose companies that are industry leaders, had high growth potential, and strong financials. No guessing, just data-driven investing. But while stocks is great for long-term growth, I also wanted investment that can generate consistent cash flow. Money coming in, whether the market is up or down. This is where real estate can be a game changer for passive income. Now, buying a property requires a lot of capital, but there's a way to invest in real estate without needing hundreds and thousands of dollars. Enter REITs or real estate investment trust. These let you own a share of income generating properties just like stocks, but with the added benefit of passive rental income. By law, REITs must distribute at least 90% of their taxable income to shareholders each year, which means investing your $10,000 in a REIT will provide a decent cash flow. Imagine owning a small piece of a mall or an apartment building. Every month, you get a share of the rental income without being a landlord. That's why I included REITs. One well-known REIT is Realty Income, which has a history of steady and growing monthly dividend income. If you invest $10,000 in Realty Income at today's price of 58.49 cents per share, you will own 171 shares. Now, Realty Income pays a monthly dividend of 268 cents per share. This means at the end of the year, you will have $550 in total dividends without doing anything. Even better, realty income has a history of increasing dividends, so your passive income can keep growing over time. This is why REITs are a smart way to build your wealth. You're not just investing, you're creating a steady stream of cash flow for your future. It's important to understand that not all REITs are created equal. Some struggle during an economic downturn or when interest rates increase, so always do your research before investing. But by combining stocks for long-term and REITs for steady cash flow, I made sure that my portfolio was both growing and paying me. This balance helped me scale from 10,000 to 100,000 faster. Later in this video, I'll share how I personally allocated these assets to grow my investment. So keep watching. So now we have stocks for growth and REITs for passive income. But what if you're not sure which stock to pick and you don't want to manage multiple investments? That's where ETFs come in. They let you invest in a whole group of companies at once, making it easier and reducing the risk for beginners. An ETF is like a basket of different companies, like stocks or bonds, all grouped together. When you buy an ETF, you're investing in many companies at once, not just one. This helps spread risk and makes it easier for beginners to start investing without needing to pick individual stocks. I own two ETFs, VOO and SCHD. These two ETFs serve different purposes in my portfolio. VOO provides broad market growth by tracking the S&P 500, which includes the 500 largest companies in the US. It helps my portfolio grow over time as these companies expand and increase in value. On the other hand, SCHD focuses on high-quality dividend-paying stocks, providing consistent cash flow through regular dividend payments. This helps balance my portfolio by adding passive income while still offering long-term growth potential. ETFs are a great option if you want diversification, lower risk, and hands-off investing approach. And depending on what you want and needs, there's a lot of different kinds of ETFs available in the market. But let me ask you, have you already started investing? Let me know in the comments what kind of asset are you investing in. I'd love to hear from you guys and see what's the most profitable asset that we have in the community. Now, let's talk about how I balance these investments in my portfolio. Now that we've covered these three core assets, stocks, REITs, and ETFs, the real question is, how do you put them together to grow your money as fast as possible? This is where most new investors struggle. Should you go all in on stocks? Should you focus on dividends? How do you prevent making big mistakes? Here's how my portfolio is structured when I scaled from 10,000 to 100,000. I wanted growth, but I didn't want to lose sleep over market crashes. So this mix let me build wealth while keeping the risks in check. 55% of the portfolio is in stocks, the core driver of growth. These individual stocks had the highest upside, giving my portfolio the potential to multiply. 43% of the portfolio is in ETFs, which gives me a strong foundation. ETFs provides diversification, reducing risk, while still allowing me to enjoy compounding. 2% of the portfolio is in REITs, my passive income booster. Even though it's a small percentage, this gives me a consistent cash flow, which I reinvest for more growth. This mix wasn't random, it was intentional. Stocks fuel the acceleration, ETFs kept things stable, and REITs ensures that I always have cash flow. You can definitely build your own mix depending on what kind of setup do you prefer. For me, this one is a pretty aggressive mix. If you want or need more cash flow and having stable income, you need to increase the yield of your portfolio by buying stocks with higher dividend yields or dividend ETFs or increasing your exposure in the REITs. It's totally up to you. So, what's your next step? Decide on how you want to allocate this $10,000. Start with a mix of asset that fits your risk tolerance and goals. The sooner you start, the faster you'll build lasting wealth. Most people hesitate. They overthink and wait for the perfect time to invest. But the truth is, waiting is the biggest risk. Imagine two people. One invests $10,000 today in solid assets and the other waits 5 years, missing out on compounding growth. Who do you think will be wealthier? Don't let fear hold you back. Your future wealth is depending on the next moves that you make today. So, here's your next step. Pick an investment strategy and commit to it. This is part 3 of the series that I posted. If you watch and enjoy all of them, drop 3/3 in the comments. Thank you so much, and I appreciate your support. If you get value in this video, don't forget to like this video and subscribe to get more videos like this. And if you want to know what changed after reaching your first $10,000, don't forget to watch this video.